好，我们谢谢浩的分享。那我们之前呢，已经收集了5个台湾投资人最关心的问题，那包括在目前通货膨胀的隐忧，以及这个股价高档的环境之下，如何做这个资产配置，还有包括成长股跟价值股之间如何做选择。那也对年轻的朋友如何在投资领域上跨出第一步，那浩尔都有他一些独到的观察跟建议。接下来我们也请浩尔来分享这个5个问题的回答。
We're going to turn now to questions from the audience, and we do have some good questions, which I'm going to try to answer. What's the asset allocation suggestion in a post-pandemic world, particularly in a reflation and high valuation environment? People talk about buy or sell, get in, get out, and I've given up on that. I don't think it's very helpful or descriptive. What I do is I talk about people's normal risk posture and where should they be relative to their normal risk posture. I think that today people should be in the vicinity of their normal risk posture, maybe if they're cautious by nature, with a little leaning toward defense rather than offense. But, things are not so bad that you should get out of the market. They're not so good that you should be aggressive. So I think normal to slightly defensive. How do you do that? Higher quality securities, safer securities, larger companies, stronger companies, etc. Now, the question goes on to ask about reflation and a high valuation environment. And if we're going to have inflation, you will prefer to be in assets that respond to and combat inflation or work with inflation, shall we say. So what are some examples? In the fixed income area, you probably want to have floating rate debt, not fixed rate debt. Floating rate debt adjusts to rising interest rate. Fixed rate debt becomes less valuable the higher interest rates go. Number 2, real estate. For example, buildings where the rent can be raised to adjust for inflation and compensate for inflation. That would be helpful. Other asset classes where, perhaps timber or commodities where prices benefit from inflation. Some of these things are hard to invest in, but I think that these are examples of the things that can be helpful. And finally, the stocks of companies that can grow their earnings in an inflationary period and thus respond. There are ways to incorporate the concept of inflation in our portfolios. The challenge is how much of it to do. Will the inflation be permanent or transitory? The Fed keeps saying transitory, but nobody really knows. You might make a nod to inflation in your portfolio. I just wouldn't go whole hog in the direction of an inflation protective portfolio. You have discussed value versus growth investing in an earlier memo. Would you please share your perspective and comments to us? I wrote a memo in January called Something of Value. It discusses the talks I had with my son, who with his family lived with us for much of the pandemic. He's a professional investor too, more interested in technology and growth and innovation than I am. But we had very productive discussions. And the conclusion was that people who call themselves value investors have really tilted toward low growth companies, not great companies, mundane companies, and in particular, companies with low valuations, low PE ratios, low price to sales, low price to book. And I think that these things have become hardened, if you will. This theology has become hardened. And the main points of our discussion and the main conclusions of the memo are that value investors, I mean, we consider ourselves value investors, but we don't have those hard rules. Value investors means you're value conscious. You're conscious of getting a good deal for your money. and not overpaying. And there's nothing wrong with that. But the hardened value theology of recent years says no tech investing, no investing in companies that are believed to be great companies and thus carry high valuations. And I think that's unnecessary to have those distinctions. I think that a value-conscious investor should be able to invest in technology or other forms of rapid growth, should be able to invest in great companies with high PEs if they're getting their money's worth. If you look, Warren Buffett is considered to be the greatest of all the value investors of all times. He made a lot of money in Coca-Cola, which he has held for, I believe, the last 40 or 50 years. And Coke has certainly been a growth company and very profitable. Buffett made most of his money in the stock of Geico, which was a growth company, and he benefited greatly from its growth. And in fact, Buffett is on record as saying that we are not growth investors or value investors. He says we're investors. And I think that's the right approach. I think you have to be a value-conscious investor, but that's different from being a, quote, value investor in the hardened terms of the most recent years. And Buffett says there's no reason to assume that low valuation ratios make for successful investments or that high valuation multiples preclude them. I think that's very important to bear in mind. The third question is, should we worry about asset bubbles and over-leveraged issues, given that we are in higher than usual territory in terms of the recent equity returns and the valuations for this stage in the cycle? What's the most important thing we should consider at this moment? Well, when there's no panic, when there's no pessimism, when there's no eagerness to get out, when there's no worry about the future, when there's no rising interest rates, it's not a great time for finding bargains. Bargains are found when we have pessimism and lack of confidence and an eagerness to get out of the market and so forth. So you have to accept, as we've been discussing, that the markets are elevated, and it has to be borne in mind. Then there's this question of whether we're in a bubble, and when you hear bubble, of course, it connotes that it's going to pop and cost us all money. There's lots of discussion about the fact that we're in an asset bubble, and there are examples of worrisome indicators: high PE ratio, ease of doing IPOs, ease of IPOing unprofitable companies, high Buffett indicator, which is the ratio of all the value of all the stocks in America to the GDP in America. There are worrisome signs. On the other hand, I believe that we're low in the economy. We're just at the beginning of an economic recovery. Remember, we had the worst quarter in history a year ago in the US, and I believe that we're going to have good economic news for the next year, at least. And I believe that the markets will not decline greatly as long as we're reporting good news. So I think that's the most important thing to bear in mind. And this is why I'm not subscribing to the bubble thesis, and why Oaktree is really investing, I would say, business as usual. Fourth question, where are the investment opportunities and risks as monetary policy moves or central banks' upcoming stimulus unwinds? The challenge today is that these macro questions are the great questions that will move the market. And I believe very strongly, and my 52 years in the investing business tell me, that nobody has the answers, or nobody has answers better than anybody else's. These are areas where it's very, very hard to predict the workings of the economy and the markets, since they are not machines with schematic diagrams which are subject to the laws of nature, the physical laws. Rather, they are driven by psychology, emotion, random developments, unpredictable developments. Very hard to say. So I think that we all have to bear in mind the dependence of market values on low interest rates, the fact that there is the risk of rising inflation, and the fact that rising inflation would cause interest rates to rise and security prices to fall. A lot of it depends on the outlook for inflation. We've had rising inflation based on supply chain glitches and tightening labor markets, tightening commodities markets. And we don't know whether this is temporary or permanent. Obviously, rising inflation and thus rising interest rates constitute the greatest single macro risk today. On the other hand, we would normally say or expect that rising interest rates and rising inflation would accompany a strong economy. And a strong economy would support the asset values to a good extent and limit the downside risk. And so, again, this is why I'm not urging people to practice maximum defense and get out of the market, and why Oaktree is really engaged in business as usual rather than practicing unusual risk aversion. The opportunities lie in the things that are under a cloud as a result of the pandemic. And there still are sectors like big city office buildings and hotels and brick and mortar retail real estate. These are all areas which are dependent on bringing people together. They were really frozen last year by the economic lockdown through which government agencies responded to the pandemic. They're reopening now, but to what extent will people go back to the office? To what extent will that translate into demand for office space? Ditto for shopping malls, ditto for hotels. So, some of these things have been marked down, and to the extent that they come back from the pandemic and the markdowns prove excessive, this is where the opportunities lie today. Clearly, anything which is not under a cloud, things where the investors believe the future is bright, these things are not cheap today, and so nobody should expect to get a bargain in those sectors. Final question. Your books are very popular. That's what the questioner says. In particular, many young people learn to invest through your guidance. Do you have any further suggestions to these readers? Well, I think that, there's two ways to learn, and that goes for everything. You can learn from history and from reading, or you can learn from experience. And, my definition of experience is that experience is what you got when you didn't get what you wanted. In other words, the most educational experiences are painful experiences, and they come from failure. You learn much more from failure than success. The young people will learn through failure because investing is something that nobody does correctly all the time, but we want to help them and learn not the hard way through experience, but the alternative is to talk to successful investors, watch videos, hard to know exactly who to watch, and read. And I think that you can get so much out of reading and avoid the painful lesson through experience. I hope my books, The Most Important Thing and Mastering the Market Cycle, can be helpful in that regard. People tell me they are, and that makes me happy. There are lots of other good books to read. I'll give you a few examples. I learned a lot from a little book called A Short History of Financial Euphoria by John Kenneth Galbraith. Extremely helpful to read about market psychology and how excesses are achieved and what to do about it. There's a book called Fooled by Randomness by Nassim Nicholas Taleb, who was the author of the Black Swan. This was his first book. I think it's an excellent book. And it talks about the role of randomness in investing, and thus how outcomes can't be predicted, and how, since randomness plays a great part in investment results, people have to expect that their results may not be what they want them to be. They have to be ready for things to go against them. They also have to realize that short-term track records may be the result of randomness, not skill, and they have to limit the faith that they put in short-term track records. Very important. Another interesting book was Against the Odds by Peter Bernstein, which is a history really of probability. And if you think, and you can't think about risk without understanding the science of probability, because all risk is, in my opinion, is the probability of unpleasant outcomes. So you have to be able to think about what might happen and what you think is most likely to happen, and the other things that could happen but are less likely or even unlikely. You have to think about these things and allow for them. And then finally, there was a book called Devil, Take the Hindmost, which explained the performance of investors and investments in the bubbles of the past. And I read it in the fall of '99, which enabled me to really have a good fix on the tech bubble that was underway at that time, and how to respond to it. So these are just some examples of very helpful books. Interestingly, if you think about it, none of them is how to invest. That is, project this and multiply by that and add this, and the nuts and bolts of investing or a financial analysis can also be learned through school or through books. My books are really how to think about investing, and in particular, how to think about investors. And I think they're very important, the books I've listed for you. I hope you'll read them and that you'll find them helpful. I appreciate the chance I've had to speak with my friends at Cathay United Bank. I hope this has been helpful.